Welcome back, investors, to Ticker Time News. I'm Adam, and Elon Musk now owns Twitter. It's completely official, and he's owned it now for an entire day. Now, if you had shares in Twitter, this may be a question. Now, what happens next? Well, the simple question is, the simple answer is, once the paperwork has cleared, then you will get a credit in your brokerage account for $54.20 a share. Depending on how many shares you have, then that's the amount that you will get back as a credit in your brokerage account. Now, moving on to today's market. It was a big green day in the market. The quote window dressing for month end was definitely in full effect, and the market bounced off exactly where we had planned out yesterday for the market to bounce. Those key levels held as support, and that's what happened. So the stock market closed out the week on an upbeat note. The major indices all logged sizable gains and closed near session highs on their for the day. The S&P 500 closed really close, just over that 3,900 level, 3,901, and it held as resistance for the last, I don't know, maybe hour or so of the day. Couldn't just break above that, and it makes sense for why it couldn't. This may be a little bit strange, but I want you to look at this. On your screen is the SPX ticker for the S&P 500. Today's candle, where we closed, if we go back exactly just about a month or so ago when we had the last FOMC meeting, yeah, back here on September the 21st, let me get my highlighter to point this out. This is kind of interesting. Right here, this candle right here on the 21st of September. That's when Jerome Powell came out and he did the rate hike of 75 basis points. Like we knew, that's what we knew we were going to get. Just like we know that this coming week, we're going to get another 75 basis point rate hike. The market sold off that day. The SPX lost 1.7%. But the wick, you can't see it. It's a little too buried in on the screen here. But the wick for the 21st of September actually comes up to right where today stopped, that 3,900 level. It actually got all the way up to 3,907, and it couldn't get any higher than that. That was the top. Isn't it a coincidence that here we are, Friday, we're going into next week with an FOMC meeting, and we pump the brakes right there at the same spot that the market kind of stopped at during the last FOMC meeting, okay? If we go back to the Monday of that last FOMC meeting week, on that Monday, the market closed at 38.99. It got to a high of 3,900 even and couldn't break above that 3,900 level. It is a tough, sticky place for the S&P 500, 3,900. On the SPY, that would be 390. It's going to be a tough one to break above. Whether we do it on Monday, I don't know. There's also, if you take the top of the summer rally and the slide that we were on all the way down to the mid-October low, and you put a fib retracement on that, we actually closed today the 3,900 level. It's actually 3,909. That's the 50% retracement level of the decline that we've been on, and then the rally from that bottom. So we have already gotten back 50% of the losses from the summer high to the mid-October low sell-off. Isn't that interesting? Another interesting point on the chart here. The charts love symmetry, and we're getting tons of it. And remember the other retracement line that I had up here? 3,500 was the low, and that was the pandemic rally going from the March 2020 low to the January 2022 high. The 50% retracement of that of that rally sliding down was 3,500 in that area, and that's right about where we tagged just slightly under that 3,500 area. 3491 on October the 13th is where we tagged. So very interesting symmetry here. The Fibonacci levels, they're in charts for a reason, because things just they just match up. It's almost magical, isn't it? So that's a little something there to point out. That also says this 3,900 area, it's gonna be tough to beat. It's gonna be tough to break above it. So we bounced right off of the line here at 38,010 today. The trend line from the mid-October all the way up, we bounced right on that trend line, just like we talked about yesterday. And we also bounced on this important line right here. They kind of matched up perfectly with the trend line for today. Those two areas, they held tight. And again, it was right around that 38.10 level where that bounce occurred. If we want to get technical, it got to 38.08, so just a couple points below that 38.10 level. But that was the big support area, that if we held it, then that would be a bullish sign, and it was. We also finally cracked above the 50-day moving average, which is coming down across the screen like that. We closed above it, obviously 39.01, and that 50-day moving average is somewhere around 38.41-ish, give or take there. So that's also very interesting that we were able to get above it and hold above that and close above that. But that 3,900 level, it is going to be very tough on Monday to crack through. And with today's rally of 2.5% for the SPX and 2.5% for the SPY, 3% for the Qs, 2.3% for the IWM, we are now disconnected from that 5-day EMA. Whenever we get disconnected, what do we need to do? We need to reconnect with it. So a pullback on Monday, it would not surprise me, not one bit. Monday will be the official last day of October, but of course, a lot of options market information expired, and window dressing. And window dressing is when you have your hedge funds out there and they are buying and trading stocks to make it look like they put in a good month for their client. So that also can help the market with this buying and rallying activity at the end of the month. Yeah, call it manipulated if you want to. I don't like to, but you can, because that's kind of like what today was. But we are at a key level of resistance, and it will be tough to break through it. And again, it's also that same spot where the last FOMC meeting does put a lid on this rally. So can we break through next week? I don't know. I don't think we're going to get too much higher than where we are now. The FOMC meeting, we're getting 75 basis points. The big deal for next week is, where will the central bank be taking us? Where's the Fed going to take us next, right? There's been a whole bunch of talk about a possible slowdown in rate hikes for December, and we could potentially see a 50 basis point rate hike. At least that's kind of like what's been being priced in right now by market participants. Will the Fed confirm that this week coming up with their FOMC meeting? I don't know if they'll confirm that or not. Are they going to talk a little dovish? I don't know. Some inflation data that came out today with PCE pricing, that came in hotter than expected. So inflation is still there. Are they really going to take the time to slow down on their rate hikes if inflation is still coming in hot? So we'll have that. We also have jobs data next week. That'll also play a pivotal role in where this market's going to go. So there's a lot of outside factors that are going to factor into this market next week. It should be a volatile ride nonetheless. Now, today, in the market, Amazon, it ended up being down 6.8%, which was a big move in and of itself, but not as far down as yesterday in the after hours. Remember, yesterday in the after hours, Amazon reported their earnings report. They were down nearly 20% almost. And by the time we went live yesterday, Amazon was down about 13.3 or so percent. So there was a nice little buy the dip there in Amazon, but it was still down significantly. And of course, that was a disappointing earnings report, and they had disappointing Q4 guidance. Now, Amazon being down was offset by big earnings driven gain in Apple. Apple was actually down in the after hours, but today Apple was up 7.6%. That was a big reason for why the market was up so much today. Apple is a mega cap company, and when it moves, it's a directional it has a directional bias on which way the market's going to go. Now, the stock market showed pretty impressive resilience today. Buyers were not deterred when the 10-year Treasury settled back above the 4% level. The 10-year was actually up 7 basis points to 4.01%. Yesterday, remember, it closed under that 4% mark. And the 2-year, it also made a sizable move today, up 9 basis points to 4.42%. So we're still 40 points plus inverted on that yield curve. Now, with the exception of Amazon, mega cap stocks had a strong session. The Vanguard Mega Cap Growth ETF, ticker symbol MGK, it closed up 2.8% versus the 1.5% gain in the S&P 500. Now, the S&P 500 sector performance reflected the broad nature of today's buying. 10 of the 11 sectors, they closed with gains today, led by information technology, ticker symbol XLK, up 4.5%. The sector was boosted by Apple, of course, but also outsized gains in Intel. Intel was up 10.7% today, thanks to a favorable quarterly result, also boosted sector gains. Now, on the flip side, consumer discretionary down 0.3%, XLY. It was the worst performer due to Amazon's big loss. However, the sector did recover nicely from a loss of 3.8% at its lowest point of the day. Also, market participants received economic data today that it did not contain anything that will prompt the Fed to reconsider its aggressive rate hike campaign, in my opinion. YouTube missed the noti. Yeah, YouTube is horrible with notifications. There's YouTube channels that I'm subscribed to. I never get notifications from them. I don't know what it is with the notification system from YouTube, but it stinks. It really does. So I don't know what else to do. We tweet about it. It goes on Discord in the public, in a public channel on Discord. It goes out on Patreon. We send it wherever we can. And then when it goes on Patreon, that's also sent out as an email. So we're doing what we can to kind of avoid YouTube's notification system and try to get the message out there best we can. But YouTube is just, I don't know if they don't like financial channels or don't like this one. I don't know what it is, but it's definitely a problem. And I've seen it too. So you become the notification for others. Share the video if you can, so that way others get a chance to see it. Now, the stock market. Looking at today's economic data, just want to touch on real quick, and then we'll look at the SPY, the Qs, and the IWM together here on the chart. And basically, we're going to point out the same thing that we just did with the SPX. Everything is kind of lining up right now. But looking at today's economic data, we got the September PCE prices. It came in at 0.3%, right on expectation of 0.3%, and its prior reading of 0.3%. So it really didn't move anywhere. But core PCE prices came in at 0.5%. The expectation was 0.4%. So that's hotter than expected on inflation. Plus, the prior reading was 0.5%. Now, the key takeaway is that with continued income growth and a slightly hotter than expected core PCE price growth, the Fed has an argument to maintain its aggressive rate hike course. Now, the other bit of data that we got was Q3 employment cost index. It went up 1.2%, rate as expected. The prior reading was 1.3%. So the takeaway here is that the year-over-year compensation cost was reduced by 10 basis points from the Q2 reading. It was 5.0% from 5.1%. So the Fed is unlikely to reconsider its aggressive rate hike stance based solely on this report. So, two pieces of data that came out today on the economy, and both of them scream to the Fed to keep on course, keep raising those rates. So the narrative of a Fed pivot, that's out the door. That's not happening. A Fed pause, nope, not happening. A Fed slowdown, I guess there is a probability, at least when you look at the CME Fed Watch tool, there is a probability. But man, I don't know. It's a tough one. Can that probability hold? I mean, it's kind of 50-50 right now. Is it going to be 50 basis points in December? Is the Fed going to slow down with rate hikes? I don't know. Also, you got 32 likes on your last stream. You should do videos on earnings yeah, I noticed that too. I noticed that. We used to do videos on earnings and specific videos. They worked out really well. There was a time when this was a much smaller channel. We would put videos out there, and I don't know if it's YouTube testing the waters or what, but we've got videos that have thousands of views on them, and it's kind of changed since then. So it is something to consider. I like doing those earnings videos back then. So maybe we'll bring them back. Can't hurt, right? Can't hurt at all. So I do appreciate that. And a lot of that came from yesterday's video was just the Intel, just a little bit about Intel stock that we talked about. So not a whole bunch. Now, the last piece of data that we got, it was related to the housing market, and that was the September pending home sales. It dropped 10.2%. So the housing market, we just continue to get sign after sign after sign after sign that it is slowing down and pulling back. The expectation for this report was only 5.1%, so nearly double, 2x, less homes on the market than expectations. Oh, lastly, the October University of Michigan consumer sentiment, we got the final reading on that. It came in at 59.9. The expectation was 59.6. So what we can take away from this is that it's essentially unchanged from the preliminary reading, though inflation expectations for the year ahead dipped slightly, kind of reversing a quarter of the increase that was seen in the preliminary reading. Now, looking ahead to Monday, we have a ton of earnings next week too. We've got XPO Logistics, we got onsemi, so the semiconductor sector, AMD semiconductor sector is definitely going to be under the microscope next week. Global payments, too many that I can name. They all report earnings next week, and most of those before the open on Monday. I do believe AMD will be on Tuesday after the market has closed. Now, economic data on Monday will be limited to the October Chicago PMI reading. The expectation is a 46. The prior reading was a 45.7, and that comes out at 9:45 a.m. And then the biggest driver next week is the FOMC meeting. It is on November 1st and 2nd, so Tuesday and Wednesday. November 2nd, 2 p.m., we get the press release with 75 basis point rate hike, and then 2:30 thereabouts, Jerome Powell will come out, and the biggest thing to look for is where are they going? Where are they going next? You know, we're pretty certain of a 75 basis point rate hike from them this time on November the 2nd. Where are they going to go in December? And again, that's December 13th and 14th. So December 14th, are we going to get a 50 basis point rate hike? Are we going to get a 75? What are they going to do? Are they slowing down or are they going to keep going? That's the biggest question that we hope get answered this coming November the 2nd, which is Wednesday. The other thing too, I guess while I'm thinking about it, is will the Fed be more dovish or hawkish in how they're speaking? Because with the market rallying like it has from the October 13th low and today's big run up, will the Fed see that as a, when we leaked, I'll put it in quotation marks because who knows if they really did or not, but when we leaked for that Washington Post article that the Fed was thinking about slowing down on the rate hikes, was that testing the water? The market rallies from that, and now the Fed is like, oh no, we need to put a lid on this rallying, right? We need to put a lid on this rally that's been underway. So will they just come out and be hawkish and say the same thing that they've said over the past several months? We're going to use data to drive our decision. That's the big thing, I guess, to watch for, is the tone of Jerome Powell and what remarks he has about the future and their direction. I would probably lean towards we'll hear the same thing we've heard the past several months from Jerome Powell. Will the market like it? Will the market take bad news as good news? I don't know. We are at a sticky resistance point at 3,900 for the SPX, 390 for the SPY. What could potentially send this thing up higher? It would have to be some type of good news. If the Fed comes out and is dovish in their tone, then yeah, the market will take that. The market will run with it. We'll probably get up to that 4,000 level. That'll be the next area of resistance. And if it does break 4,000, there's an air gap on the volume shelf profile from 4,000 all the way up to 4115. So where are we going? If we get to 4115, there's some big headwinds at that point. And that would be a very significant area. And if the market broke through that, most market participants will take that as a very bullish sign, but that is looking too far ahead. I can't go that far. It's tough enough to try to determine, you know, what's going to happen over the next day or two. Definitely can't go that far out. But let's go over to the SPY, the Q, and the IWM here and look at this. So for the SPY, very similar setup and situation as to the SPX. Again, the SPX, I use that one more frequently because it does have more money flowing through it, higher volume of transactions being made. So we got that. All right. So here for the SPY got up to a high of 389.52, just pennies off from where it closed on the day. So it really got up to that 390 area, just couldn't break through. And if we go back in time to September the 21st, which is when the last FOMC meeting was, the high there was 389 also. So that's where the market stopped. The last FOMC area, where the stock ran, where the SPY ran up to during that last meeting. So I do find it interesting. Now on the SPY, it's 391 to get to the 50% retracement level. So while the SPX got to its 50% retracement level from the summer high to the mid-October low, The SPY didn't quite get there, but the SPY did do what the SPX did and closed above its 50-day moving average. That's always a bullish sign. It also, excuse me, bounced right off the trend line that we had right here from yesterday, and it bounced exactly where we said it needed to. If there was a breakdown below that line, then this could be over. All right, this bull run that we've been on here, this rally that we're in, it could be over, but we didn't. We bounced right on that trend line, so that was a good call yesterday. I really like it. Now, it is a bit disconnected from its 5-day EMA, so that's going to be something to be concerned with on Monday. It's also at that 390 level, which is a resistance area. So I do have some concerns about Monday and what could potentially happen. So just be cautious on Monday. Maybe let the market breathe in the morning and see which way it wants to go. Now, looking at the Qs, a little bit different of a setup here than with the SPY and the SPX. I'm going to take the fib, the old fib off as soon as I get rid of my highlighter here. And I'm going to put the new fib retracement on. All right, so I'm going to go to the August 16 high, okay? And that's where I'm going to start the fib. Oh, come on. All right, let's try that one more time. We're going to start on that high, and we're going to bring it down to the October 13 low. Line it up right there. Okay. Now, when we look here for the Qs, when we're looking for that 50% retracement level here, let's open this up just a little bit more. Pull it up out of the volume there. So where the Qs closed today, even though it was the biggest mover, it's been lagging the past couple days. So this close right here today did not get up to the weekly expected move. It is not near the 50% retracement level, which is more up here, which is at 286. 50% retracement, 286. So we're $5 and some change, $6 away from that point. So the Qs, they do have a little bit of extra wiggle room here. However, if we look at this red line, I know it's hard to see. There's all kinds of lines on here, but it matches up with over here. That could be a sticking point for the Qs, and that's at 284. So we got 284 to 286. That could be a zone there to keep in mind that could hold the Qs from launching any higher, just like 390 is for the SPY and 3900 is for the SPX. Now, if we go back and look at September the 21st here, I didn't mark it, but it is this candle right here. The Qs got all the way up to 293. That's up here. Oh, my highlighter disappeared, which is up here. So can the Qs get back up to where the FOMC meeting occurred last month, like the SPY and the SPX did? That's a big question. Now, that is an interesting spot. And as a matter of fact, I called out the wrong. Hold on. The old Fibonacci lines did not delete. So let me delete those now. Okay. My mistake on the 50% retracement. The 50% retracement level for the Qs is at 294. It is this line up here. All right. And that's exactly where the FOMC meeting from September took the Qs. So the Qs have some room here that they could move, but obviously big tech, November is typically the best month out of the year for the NASDAQ and the technology sector. So it could make up this room right here in the month of November. But again, the Fed is going to play a role in that decision and whether it can rally that far or not. Okay. All right. Let's clean up these highlighter marks here. And we'll go, and I want to take this old fib line back off again. All right. Cool. Now let's go to the IWM and do the same thing. We'll add the Fibonacci there to it as well. All right. Again, we're going to go to the high on August 16th. And we're going to put this fib line in and pull it down all the way to that October 13 low. Okay. There we go. No, where'd you disappear to? It's strange. Sometimes TradingView, when on the live stream, just doesn't want to work. Sometimes these other trend lines get in the way. All right, there we go. All right, bring it down here to the bottom now. Okay. 50% retracement for the IWM was at this 181 area right here, and it closed at 183, breaking above that. And then if we go back to September the 21st and look at that high, the IWM actually broke above the September 21st, which was the last FOMC meeting, which that high was 181. So real close to the 50% retracement level there. So the IWM, it has been running much harder than the SPY and the Qs to break above this. Can it hold? Is it going to continue going maybe to that 200-day moving average, which right now is sitting at 187? That would be interesting. And again, with all the outside forces for next week, it's going to be a tough week to figure out what's going on. Because the market has the opportunity to take good news as bad news and bad news as good news and be illogical and not do what we might expect it to on a normal basis. The other thing that I want to point out, and this goes for all of them, the SPY, the Qs, and the IWM, all three of them, if we go back to the September 21st FOMC meeting, the RSI for all three indices was much lower back then, and we got that big sell-off, making a new low in September, a new 2022 low in September. That occurred, and the RSI was already much, much lower. It was, where would it be sitting at here? For the IWM, it was at a 36. Right now, the RSI is at a 64. So the relative strength is even stronger right now going into the FOMC meeting than it was last month. So it's very interesting. I wonder how it would react to the 75. See, I think because the 75 is baked in, I would think. CME Fed Watch Tool. Let's pull this up. See, 75 basis points, the probability says, that's what we're looking at. %81 right now for November the 2nd. 81.3% probability of a 75 basis point rate hike. That's going to take us to 4%. And then if we click on December, right now it's nearly 50-50. 46.8 of a 50 basis point rate hike, 44.9 for a 75 basis point rate hike. So December right now, the market's split like 50-50 on where it could be. And there's actually a little tiny 8.4% of a probability of a 25 basis point rate hike. So it's all about the future and December. I don't think that a 75 basis point rate hike is going to shake the market next week. I don't think so. It's going to be about December. December is what's going to move the market. And if we get the same old hawkish stuff that we've gotten from the Fed for the past several months in a row now, I don't know if the market's going to take that very well. I think the market is expecting the Fed to come out and be a whole lot more dovish than it has been over the past several months. All because of that Washington Post article. And that Washington Post article is what has sparked the fever of a Fed slowdown. And for people to even use the word Fed pivot, that's not happening. No, the Fed's going to 5% in 2023, Q1 of 2023. I don't see them stopping and cutting rate hikes. Inflation is still going up. Employment still remains strong. So as long as employment is strong and inflation is high, there's no way the Fed is going to stop. No way. So people are dreaming, talking about a Fed pivot. People are dreaming, talking about a Fed pause, a Fed slowdown, maybe. And that's solely based on that Washington Post article. So what the Fed says next week, it could tank this market. It could really take the wind out of the sails on this rally that we've been in if the Fed remains hawkish. I just don't see any other way around that. However, if the Fed is dovish and that Washington Post article becomes fact, that many Fed officials are thinking that they need to slow down, the market could rally on that news and take a Fed slowdown too far, like they did with the summer rally. That was taken too far. All right. Well, that is everything I had for my notes today. I know it was brief. Not too much happening. It's Friday evening. Don't want to keep you too long. So if you have any questions, plug them in now. I'll give you a couple minutes to do so if you would like. Otherwise, if you could click that like button for me and share this video, that really does help out. And then if you like the perspective and you want more, click the first link in the description. Knowledge is key to beating this market, and I think we provide some pretty good knowledge for our private investor community. So consider that as well. Okay. Do you think Apple has too much weight? Well, today was ridiculous, but also remember this. There was a lot of, I know I keep using the word window dressing. I'll say it in quotes for today. A lot of the hedge funds today want to show their clients on that next billing that, hey, we were able to turn this thing around and get you some gains in the month of October. So that had a part to play in today's rally. But Apple was a big time contributor to the market as well. I do think Apple does have too much power over the market, but it's because of that market cap and how many people hold Apple in different ETFs and how many individual investors hold Apple in their portfolio, but mainly it's the ETFs. Look at all the ETF products that have Apple in their holding. So when Apple moves, it does have an oversized effect on the market. Let me scroll down here. $2.5 trillion market cap. That moves the market. So when Apple moves 7.5%, that is definitely going to have an impact on the market. And I'm actually kind of curious here. Where has Apple gotten back to? So I'm going to put a fib line on this. Again, from the summer rally high to the low on October. And you can see Apple rallied today right back up to that 50% retracement area. And that's where it closed. And if we go look at September 21, not quite there. September 21 is where the wick of today kind of matched. But it did close back below it. And it did close right on its 50% retracement level. It tried to break above its 200-day moving average, but it couldn't. It pulled back from that today and closed right on that fib retracement level at 155, 50% fib retracement level. So you've got that for Apple. So yeah, it does have an oversized weight on the market. And that's just because of how many ETF products that Apple is in. So nothing we can do about it. Just have to work with what we got. All right. Anything else, or we can wrap it up for tonight? Just let me know. If you got anything else you want to talk about, we can for sure. Just going back to Monday. Monday is going to be a tricky day. Probably maybe a redder day. Just because of how big of a move was made in the market today. I broke my losing streak. Oh, that's good. That's good. That's good. I'm glad to hear that. Really glad to hear that. Yep. A lesson that I learned when I started trading about losing. You're going to lose in this market. You're not going to win every trade you make. You're going to lose. And being able to take that loss and not allow it to turn into a bigger loss is key. And take that loss and learn from it whatever you can. I know the market does not act rational all the time, especially in bear markets. In bear markets, the market can be completely twisted and turned upside down in how it works, which makes it even more difficult. When volatility goes up, that also makes it worse. But just don't let a bad trade turn into a awful trade or a worse trade. Try to learn from whatever happened with that trade to improve upon it. And yeah, that's it. Just know that you're going to lose sometimes. And when volatility is high, shrink down that position size. That's important. So super excited for you. Glad that happened. All right. Well, if you're good, I'm good. And we'll wrap it up for tonight. Thank you guys for being here with me, and ladies, I greatly appreciate it. I'll see you back here Monday after the market has closed to talk about what happened, why it happened, and what to expect going forward. There's not much economic data on Monday. Earnings will be a key driver for Monday. Also, we're at a key resistance area. So that could also play into how the market reacts on Monday. If you want to see a rally continue, then you want to see these key levels. You want us to break above them and hold above them and close above them. That will be key. Yeah, I need to remember that volatility part in the 100. Yeah, the $100,000 account thing. So when volatility, the VIX, go to the VIX here, VIX, and use the CBOE, which on TradingView is the second one. When you're in a normal bull market, volatility can be 10, 12, 15%. That's kind of where it plays at. And when you're used to trading with volatility that low, take a $100,000 account. When volatility doubles, it goes from 15% to 30%. That's like having a $100,000 account, but it trades as though it's a $200,000 account because volatility doubled. So that means the market's moving at a faster rate. The swings from highs to lows are much faster. So when volatility goes up, as volatility is going up, you should be making those position sizes smaller and smaller and smaller as volatility rises. That's one way to protect your capital and to adjust your risk based on the market conditions. That's important, very important. You can see here the VIX been coming off, but we still got a 2.5% move in the S&P 500 today. But again, a lot of that was due to hedge funds wanting to show their clients a nice profit, and then of course Apple. So yeah. Okay, wonderful. Well, I'll wrap it up here. Thank you, ladies and gentlemen, for being with me. I greatly appreciate it. Have a wonderful weekend, and I will see you on Monday. And for our private investor community, I'll talk to you over the weekend with our sending out our big picture review, and of course, our weekly expected moves on Sunday evening. So have a great one, and I'll see you in the next video. Take care.